Daily drawdown, max drawdown, profit splits. What are those and what does it mean for my trading? What up, folks? It's your boy Ed Cat from Forex Insights SA, and we're coming at you with another video. Today, we're going to be talking about what is prop firm trading and what are the differences between prop firm trading and self-funded trading. A lot of you have been asking questions about what are prop firms, how do they work, what does the max drawdown rule mean, what does the daily drawdown rule mean, and how can you use prop firms to accelerate your trading to get you as profitable as possible, as fast as possible. Well, this is how all of that works. So prop firm funded challenges are really different to how self-funding works. With self-funding, you connect with the broker, you deposit your own money into the broker, and you trade that. How you go about trading that, you basically make up your own rules as to how much you're willing to risk in terms of the total account. If you're willing to risk the entire account, if you're only willing to risk half the account, if you only want to risk 10% of the account per trade, you're the one who makes all the rules. With prop firm challenges, however, in exchange for giving you more capital to work with, they create the rules for you. So at any given time, you have rules and stipulations about what your max daily drawdown is, what your max overall drawdown is, and what your profit target is before you make any sort of money from the prop firm. So the rules are a little bit different as it is with self-funding, but you can use those differences to your advantage. There are multiple prop firms to choose from out there, whether you're going with the FTMO, whether you're going with a vault funder, the 5%ers. There are a whole host of prop firms to go out there, but they all share a lot of common rules in place together. One of those is your max drawdown rule. What the max drawdown percentage rule means, that's the maximum amount of money or the maximum percentage that you're allowed to lose on the prop firm at any given time. What that specific percentage is depends on the prop firm you're using, what the account type you're using is, but it tends to range between 8 to 10% on average. So what that means with the 10% example is you're not allowed to dip below 10% of your starting balance at any point in time during that account's lifetime. So if you had a $10,000 account, 10% of that is $1,000, which means you're never allowed to lose more than $1,000. If you do, the account is breached, it's gone. That is all she wrote. So that is what that max drawdown rule is about. If you have a $10,000 account, once you get to $9,000 and below, the account is gone. Your max daily drawdown is also a hard breach violation, meaning if you break the max daily drawdown, you're going to lose the account as well. And that is the maximum amount of money you're allowed to lose in a single day. For most prop firms, that tends to be 5%. So on the $10,000 challenge, it means if you go below 5% in a 24-hour period, the account is gone, it's breached, you've lost it. So even if you still have room to spare on your max daily drawdown, if you surpass your max daily drawdown, that is all she wrote. So for the $10,000, that's going to be $500. If the account dips below $500 in a single day, in a single 24-hour period, the account is breached. And that is how these prop firm drawdown rules work. Prop firms then will also have a percentage profit target. For most accounts, it tends to be 8 to 10%, and it tends to match what the max drawdown rule is as well. So on the prop firm account, if the max drawdown you're allowed to have on the account is 10%, the profit target that you're trying to reach for your phase one tends to also be 10%. And what that means is, in order to move from phase one to phase two, you need to make 10% overall on the account. So if you have a $10,000 account, you need to make $1,000 in profit from your starting balance in order to pass phase one. Typically for phase 2, it drops down to 5%, meaning you need to make $500 to pass phase 2. And once you're in phase 3, whatever you make there tends to be yours according to the profit split. The profit split is how much of your total percentage gain is going to come to you versus how much is going to be reserved for the prop firm themselves. Most prop firms have an 80 to 20% split. Some of them have upgrades where you can go 90-10. But what that basically means is on the average default 80-20 profit split is 80% of what you make is going to come to you as the trader. 20% is going to be reserved for the prop firm. So let's say you have a $10,000 account. You made $1,000 in profit gain on the funded phase of the challenge. What that means is $800 is owed to you, whereas $200 is owed to the prop firm, and they reserve the right to keep that for themselves. This only really applies once the account is all the way passed and you've passed phase 1 and phase 2. The profits you make in phase 1 and phase 2, most prop firms ignore those as those were part of the evaluation phase. So the profit split only really kicks in once you've passed phase 1 and phase 2 and you're in phase 3. Now, moving on to risk management. Because you're never allowed to lose more than 5% in a single day, and you're never allowed to lose more than 10% overall, you need to have certain risk management strategies for how you approach the prop firm challenge. If you don't really understand what risk management is like, you can go ahead and check the video up below. I'm going to link it. I did an entire video on risk management and how to go about it. You're going to need to apply that when going for your prop firm challenge. Now, prop firms have eliminated the time constraints that used to be on there. In the beginning, you used to have to pass your phase 1 in 30 days, pass your phase 2 in 60 days. Now you have an unlimited time for both. So because you have an unlimited amount of time to pass these challenges, steady the course, the tortoise wins the race, go about it slow and consistently. The people who try and rush passing these things are the ones who tend to fail them rather quickly. It is nearly unforgivable to breach an account within the first week, because that tends to mean that you are not practicing good risk management. An account should last at least a month before it's either passed or failed. Failing an account is fine. Failing an account very quickly is not. So risk management is going to be your friend when trying to go about these prop firm challenges. So if you found this information on how prop firms work useful, go ahead and hit the like button, go ahead and subscribe to the channel, and you can pop in the comment section what you would like to see a video on next. Do you want certain things explained a little bit more? Would you like what strategies you can use to ensure success when passing a prop firm challenge? Go ahead and let me know in the comment section down below. This has been Forex Insights SA with another video, and I will see you in the next one.